Hello, everyone, and welcome. Thank you for joining us today for real estate tax moves that actually matter. We're glad you're here and excited to have such a strong group of investors and property owners joining us. Before we get started, a few quick housekeeping notes so everyone knows what to expect. First, today's session is being recorded. The recording, along with a copy of the slides and the speakers' contact information will be sent to all registered attendees by the end of the day tomorrow. So no need to worry about taking detailed notes or missing anything. Second, you'll notice two different ways to interact during the webinar. You're welcome to general comments, reactions, or notes you want to share with other attendees. For questions, though, please use the Q&A box, which is a separate area that you can click on. This helps us keep everything organized and ensures questions don't get lost in the chat. We'll be addressing questions at the end of the presentation. If we're not able to get to every question live, those unanswered questions will be followed up on offline after the webinar, so you'll still receive a response. Our speaker today is Nicole Green, a tax advisor with Robert Hall and Associates. Nicole is a federally licensed enrolled agent and nearly a decade of experience advising and preparing tax returns for individuals, partnerships, corporations, and other entities with complex tax reporting needs. Her work and insights have been featured in outlets like the Wall Street Journal, HomeLight, and Impact.com, and she is known for her ability to explain tax concepts clearly without losing sight of the rules that matter most. Nicole brings a practical, real-world perspective to tax planning, especially for real estate investors who want clarity, not theory. With that, I'm going to hand it over to Nicole to get us started.
Hi, everybody. Thank you so much for the intro. It's quite nice. I want to say, of course, welcome. We are going to talk today, obviously, about taxes because that's what I do. I want everybody to understand different ways and different strategies that people can use. And so today I've prepared some examples of several different strategies. I think it can give people kind of like real, like sometimes people talk about taxes and it just can get so like mumbo jumbo-y. Like if you ever heard like your doctor, like a doctor talking to another doctor, sometimes it's like, wait, what are we talking about? And I understand that can kind of be the same in taxes. And so I want people to see some of the strategies that you can use in when it comes to real estate, because real estate is one of the best investments that anybody can ever make. The number one investment, if you're looking over time versus energy, time and money, is going to definitely be focusing on your taxes, because the amount of money and energy that you need to spend to save more money on your taxes is pretty minimal in comparison to other types of investment. But right after that is real estate. Historically, it's just been the world's greatest investment, not just here in the US, but all across the world. And so I want people to see the different types of strategies. There's a plethora of strategies that people can use, and it's not just one thing. Sometimes you do two or three things layered on top of each other, but they all have their good and their bad aspects to it. And so we're going to talk about just a couple of those strategies so people can see and understand what's going on. As earlier stated, I work at Robert Hall and Associates. We are a tax firm. What that means is we generally just focus on tax. And so tax is the fun part about tax is it incorporates and encompasses all different aspects in the financial world. And that's one of the reasons why we love taxes so much, is because I get to see all those other things without having to do it. I can see it implemented. I can understand it. I'm like, no, we don't qualify. We do qualify. Boom, bam, boom. And so that's one of the reasons why I generally love this firm so very much. We've been around for like ever, so we kind of know what we're doing. I'm going to give you here the QR code, my email, nicole.green@roberthollandtaxes.com. If you have questions, if you want to set up a discovery call where we can talk about what you have been doing. Are some of these strategies available to you? What are the strategies that might be available to you? We can have a quick chat about that, completely free. I always make the same joke about how people find me at the grocery store and they find out that I'm a tax accountant and it's just like an attorney or, a mechanic or a doctor. When you find one, you're like, oh, wait, I have a couple of questions. And because generally, obviously, it's hard to get us. And so this is one of the reasons why I love the fact that my firm offers these free calls. I enjoy doing them because I just love chatting with people about their situation and just kind of doing the aspect. So it's always a win-win for us. I want to also say I'm not giving out real estate advice. I'm licensed by the federal government. I'm based here in California and Los Angeles. We work nationally and a little bit internationally as well. Okay, so as I said earlier, there are multiple strategies that people can use to affect their tax, and we're going to focus on three strategies, which there's others, but three real strategies that are common and highly talked about, but we're going to kind of break down them and you can see them in effect. One of these strategies is real estate professional. And what real estate professional is it's the designation that real estate is your business because the government thinks of real estate as a passive activity. And that's just, if you really think about the basics of real estate, not your one particular situation, but if you think about it as a whole, if you have a rental, it's going to be passive. Are you going to be there every day? Your tenant would be very upset if you were. So, like, no, you're not going to be there every day. There's really should be no need if everything is running in the most ideal and perfect situation. Obviously, sometimes you do need to step in, but it's not an active type of situation. And so on your tax return, when you have rentals, 9 times out of 10, maybe like 8 times out of 10, that rental will show a loss on your tax return. It should still cash flow, but on the tax return, it will be at a loss. And that's all because of depreciation. You have a rental, the rental is going to be depreciated over a series of time, 27 and a half years, most likely. And that is going to cause for on your tax return to show a loss, which is great because that basically is meaning the positive income you're getting from the rental is tax free. And when you have these losses on your tax return, they are considered passive losses because real estate is deemed passive. And passive losses can go against passive gains. And if you work a regular job, you have what's called earned income, which is active. And if you have passive losses, it can't go against that. And so that kind of sucks. But if you are a real estate professional or if your spouse is a real estate professional and the real estate is inside your spouse's name, then you're telling the government that, hey, this is not passive because this is my job. And so then the government says, oh, okay, it's active. And so the rental has now active losses that can go against the W-2 income, it can go against the retirement income, it can go against any other types of income that you have because it is no longer passive. Um, and so with everything, there are the good, and there is the good and the bad that comes with everything. And so I want people to understand the whole aspect of it. When you're looking to become a real estate professional, we'll talk about the qualifications for real estate professional in just a second. But when you're looking to be a real estate professional, we always want to make sure, is it worth it? And so because being a real estate professional or claiming real estate professional on your tax return, taking that election on the tax return does draw extra attention because it's really easy to take this election. You're just checking a box. And so you'll get people like on TurboTax going like, oh, I have rentals. I'm a real estate professional because I'm an investor, and they don't actually qualify for it. And so then because people have messed it up so many times and falsely claimed it so many times, it does draw extra scrutiny. And it doesn't mean it's going to trigger an audit by any means. It just may cause a little bit of extra attention. And so you need to make sure that you're doing it correctly, and we're also doing it so that there's a benefit. Like, for example, if our rentals are showing positive income, what's the point of us claiming real estate professional? There's no benefit for it. You don't need to also claim real estate professional for the rest of your life. You can claim it one year and not the next year and again the other year because it's all about how you qualify and when you're qualifying in that year. So let's talk about the qualifications. There's three things that you need to meet, three tests that you need to meet. The majority of your earned income must come from real estate. And so that just means the majority of your working income needs to be from real estate that you're at least a 2% owner in. And so if you work for a if you work for you're a real estate broker or an agent or an attorney and you're working a W-2 job, that's not going to count unless you also get a K-1, like your partner in that firm that you're working for as well. But if you're, 1099 and you have a company, then okay, great, now that counts. And the majority of your working time needs to also come from real estate, and you need to meet the material participation requirements. And material participation requirements is 750 hours a year. That's the easiest one that like everybody can meet that. Coming to this seminar webinar, it counts as those hours, it counts to those hours. So it's the three things that you need to do: the majority of your income, earned income, excuse me, the majority of your working time, and the majority in the 750 hours. If you meet those three, and all three, not one or two of those, then you can say, yes, I'm a real estate professional. Change your passive losses to active. I had somebody, just to give an example, I had a client worked for, I don't know, I don't remember, it was one of those big companies, and he only worked like 10 hours a week because he was like coding or something, I don't know. And he like was like, Nicole, I promise you I work like 10 hours a week. And he was really getting involved into real estate. And then I was like, great. And he's like, I want to be a real estate professional. And I was like, unfortunately you can't, because his W-2 job generated more money than what it did on the real estate side, even though he spent more time on the real estate side, and even though he was more focused on the real estate side, his W-2 job generated more money, so he was not able to be a real estate professional. And that's what I'm trying to really kind of drill into people's heads, is you have to meet all three rules at the time. And so you may have one year where unfortunately you lose your job, or you're in the middle of changing jobs, or maybe you decide to have kids and you stay home for a little bit with the kids. And so now you can qualify. And that's totally fine. You qualify for a couple of years and then a couple of years you don't because you went back to work or whatever it may be. That's totally legit and fine. It doesn't mean it has to be something forever and ever. Now, when you become a real estate professional, I want you guys to actually see an example of how it can affect. So, as I said earlier, passive losses go against passive gains. There is a little bit of exception if you're MAGI, or modified adjusted gross income, excuse me, basically the amount of money that you make. If it's under 150,000, you are able to take a little bit of the passive losses to go against other types of income. But if it's over 150,000, then no passive losses are going against other types of income. And so in this case, this person has $259,000 of other income. And so their rentals, while it generates a passive loss, they're not able to take any of that passive losses because their income. And so their total tax is nearly $24,000. We're in all of my examples today, we're going to focus on total tax because people need to pay attention to the bill. We need to understand what do we owe before we care about when it gets paid. We always got to focus on the whole bill, and then we focus on when it gets paid. And so in this case, their federal tax is nearly $24,000. We made them a real estate professional, and they were now able to take, because this is a married filing joint family, we made one of them marry a real estate professional, and they are now able to take $37,000 of losses to go against that other type of income, and it dropped their tax to $14,000. They saved nearly $10,000 by just doing real estate professional. No other changes were made. Keep in mind, this was a married filing joint. Keep in mind, they did meet the certain standards of how to be able to do this. And so it's not that every strategy fits everybody. But in this particular case, by being a real estate professional, they saved nearly $10,000 on the federal side. They're going to also get this savings on their state side as well. And so by doing nothing, you just reduced your tax. It's a really fun thing to do if it makes sense. And that's kind of what you want to look at is when does this make sense and what do I want to do with it? And so another thing is what some people do is with making their rentals short term. Short term rentals can be great. And short-term rentals, generally, if they're done correctly, can produce a lot more income than like long-term rentals. More work. And because it is more work, you can now call that short-term rental as active. And that short-term rental, if you are offering a daily service, can now be put on your Schedule C. And when it's put on the Schedule C, that shows an active loss. That active loss can go against other types of income. When you can do this is if you're offering a daily service. This daily service can of course be at cost. It doesn't need to be free and it doesn't need to be opted into every day for you to qualify. You just need to offer a daily service. Generally I see people offering cleaning or like transportation or something like that, like uh yeah, generally that's what I see people doing with those daily services. And so in this case, they offer the daily service, then they put the rental now on a Schedule C, one of the rentals, not all the rentals, that allowed them to be able to have $11,000 of loss. That also keeps their Maggie under 150. And so they're able to utilize some of their passive losses as well. Without that $11,000 of loss, their Maggie would have been over the $150,000. And so they would have missed out on that $4,700 of loss. And so by having the short-term rentals, they were able to generate $15,000 of losses. And this is something that I try to explain to some people is that a lot of times when I'm looking at people's tax returns or like I have new clients that come in and they're like hoping and praying for like, $30,000, $40,000 of reduced taxes. Yes, we can get there, but it's not going to be just one big thing that magically does it. It's small little things here, small little things there that can save a couple $1,000s here, a couple $1,000s there, and then put all of that together, and then boom, that's how we can get it. Maybe there might be one big thing in there as well, but it's always just kind of like refining and optimizing people's tax returns to suit their goals in the way that they want them to do. Because having a short-term rental definitely is not for everybody. Turning your rental into a short-term rental, you really need to know the ins and outs. It needs to be in the right neighborhood because there's city laws that go into effect. Your depreciation rates are going to change. And so you need to think of things in a long-term aspect. What are we using this for? What is our intentions? Because your tax returns, as anybody that has ever purchased a house will gladly tell you, your tax returns are not 1 year in and out, boom, bam, and then now you're done. Your tax returns are going to follow you for multiple years, which is a good thing and a bad thing, like just like everything, it's good and bad. Okay, so I was speaking a little bit earlier about how your depreciation rates will change. And so I want to talk about the second strategy, which is cost segregations. Before I get into what a cost segregation is and how a cost segregation works, I want to just go really quickly and explain some of the fundamentals just to make sure everybody's on the same page. When you have a large asset, when you have any types of large assets, they need to be depreciated if they are used for business purposes. If it's just personal, like my primary residence, we're not going to go ahead and depreciate it. What depreciation means is you take that cost of that asset and you spread it over a period of time. How long do you spread it over? That is predetermined by GAAP. And so if I were to buy a car for my business, that is going to be spread over 5 years because GAAP says vehicles basically have a life of 5 years. So I buy $100,000 car, then generally I'm going to have $20,000 of a deduction every year, close to that. And so for a house, it's going to be 27 and a half years. If it's a residential property, if it's a commercial property, it's 39 and a half, et cetera, et cetera. And so certain things have different timelines. It's not everything has their own time. It's not everything has one timeline. Everything has their own timeline. And everybody in the accounting world knows this because we all follow GAAP. We don't determine it, GAAP does, General Accepted Accounting Principles. And so, because everything has its own timeline, there's different rules. And bonus depreciation has been talked about very, very much. And bonus depreciation is now back at 100%, meaning that instead of me taking that $100,000 car that I purchased and having $20,000 every year of a deduction, I am now able to have 100% of that deduction in the first year that I put that car into service. And so I can take $100,000 of a deduction in that first year if I want to use bonus depreciation. And with that in mind, we have cost segregations. Cost segregations is when an analysis is done on the property. You have a licensed cost seg professional go to the house or view the house, and then they will itemize everything inside that house. And you bought the house for $1 million. The land, we're going to go ahead and give it, the 300,000. And so we're looking at 700,000 of usable depreciation. They will go through and they'll say the carpet is worth 5,000, the windows are worth 15,000, the refrigerators with 2,000, blah, 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 blah. They go through and they itemize all those particular things. And things that have a 5, 7, 10, 15-year life are able to be bonus depreciated, meaning you can take 100% of that deduction as opposed to spreading it over 27 and a half years. I can take 100% of that deduction in the first year. And so, what that means in the most basic terms is you can now go into the future and grab some of your deductions, grab a big hunk of them, and pull them forward. And so, which front loading your deductions in the current year can greatly reduce your tax liability. When people are doing cost segregations, they're seeing very significant tax drops, which I am all about if we're using it correctly. And so let me give you an example of what it looks like when people are doing a cost segregation. In my example here, we have somebody that has two rentals. We have an old rental and we have a brand new rental. The brand new rental has a little bit of loss. I don't remember what the amount of loss was, but it was a little bit. It was like maybe like $3,000 or $4,000 of loss. The old rental, because they've depreciated the crap out of that rental already, is showing positive income. So let's say it's showing like $37,000 of positive income. We have a little bit of loss from the new rental. And so we're looking at showing netting about $33,000 of positive income. And that puts their total tax on the federal side at nearly $21,000 of total tax. This is fine. So then we say, go do a cost seg on the new rental, not the old rental, because bonus depreciation is really only effective on the first year. We can't use bonus depreciation on something that's been previously depreciated because it's the first year that you put it into service. And so we had them go do a cost seg on that new rental. And when you do that cost seg and you're using bonus depreciation, it's really the first 3 years that you're going to see really large deductions. And here they were able to have about $45,000 of accelerated depreciation. And that took that $33,000 of positive income coming from the rental, and it took it down to an $11,000 loss. That $11,000 loss reduced their tax to a little bit shy of $12,000, a little bit over $11,000 a year. That they went from nearly $21,000 of total tax to $11,600 of total tax because of this cost segregation. Wonderful, amazing, we love it. But we're not done. The next step is, what do you do with your tax savings? Should you go to Tahiti and go on vacation? Should you buy a new car? Should you pay for the quinceañera or the bachelorette party or whatever? No. You need to take that tax savings and you need to go and make it work for you. Take the tax savings, save that tax savings for 1, 2, 3 years. Now go buy another house. Do a cost seg on that next house, rinse and repeat. Tax savings again, go buy another house, da, da, da. Because the whole point of it is, in the future, I'm taking away my deductions. I'm saying I want those deductions now because I'm going to use that money now to better my situation. Use that money now to invest, grow. And yes, we're going to have an issue in the future of having a lot more income, but we're going to have a lot more income. And that now is a fun problem because we have a lot of income coming in. And so you've grown your portfolio, you 3x, 4x, 5x your portfolio without having to invest new money. Yes, you've depreciated the crap out of the properties. So trying to get out of the properties is going to need some thought. Getting out of the properties isn't going to be completely easy, but we're going to talk about reasons and ways that you can start to get out of a property. Cost segregations are wonderful, wonderful tools. Cost segregations work really well with multifamily and commercial properties, and that's solely based on how they are constructed. If you think about it, single family homes are going to be spread over a large amount of place, a large amount of land, and then while multifamilies are usually stacked on top of each other, and so they have a lot more construction, so there's a lot more material to itemize. Same with commercial as well. And so commercial, just the way they are constructed, and multifamily homes can generate just a little bit more in the acceleratable depreciation. I remind people that you need enough depreciation when you're doing the cost seg, because it costs money to do the cost seg. You have to pay an analysis. You have to pay for an analysis, and somebody usually goes out to the home to do this analysis. You also have to pay for your tax preparer to implement the cost seg so that it can actually come to fruition. And so you want to make sure that your tax savings can cover the expenses and still do whatever we were trying to do in the first place so that we could have this cost seg, whatever the whole goal was in the first place of doing it. Now, I talked about how we've completely depreciated the crap. If we did a cost seg, we completely depreciated the property, which, okay, great. But now if we want to exit out of this property, what do we do? Because we're going to be left with a huge bill. And I like to think of depreciation as female. I like to think of her as a wonderful tool that you can use. And if you massage her just correct and use her just right, she can help you flourish, grow, expand your portfolio, save money. Your life can be so much better. But if you're a little nasty and you're a little quick and you're a little, she can come back and smack you in the face. And that is, if we're trying to sell a property, we're going to have to recapture all of this depreciation that we did. And recapturing depreciation can be very painful for people that don't realize. And so, again, it's just another example of why it's long-term strategies, why you need to do a little bit of tax planning before you do any types of moves. And one of the ways that you can get out of a property that has been fully depreciated is through a 1031 exchange. A 1031 exchange is where you sell one of your properties, one of your business properties, and you take all of that and you move it into another property, another investment property or something like this. And now, because you did this exchange, we completely deferred the tax. We told the government, I don't want to pay that yet. Write me a bill, and I will write you an IOU, and we'll just hold this IOU here, and then I will keep living my life. And if you hold this IOU forever until you die, then The IOU will go with you when you die. And that's the beautiful thing about 1031s is you can depreciate the crap out of your property and then you can defer that tax, keep deferring that tax, and then you die and your beneficiaries, the people that inherit your stuff, your estate, your final return, nobody cares about that fact that you owe the government hundreds of thousands of dollars in deferred gains. Nobody cares. It goes completely away. And so this is a really great way, a 1031 is a really great way for people to move properties around and to move in their things that they want to do. And let's not even go with the cost side. Let's just say I have a rental and now I want to go from a single family home to a multifamily home, but I can't get into the multi unless I sell this single. Yes, I have some money to put into the multi, but not enough. I need to sell this single so I can get into the multifamily. You can 1031 into it. The government understands that sometimes you need to utilize and manipulate this other investment so that you can grow with this new investment. And it doesn't have to be a 1031 from single to single or commercial to single or commercial to residential. It can be any type of mix that you want. The amount of mixing that you can do with 1031 is pretty crazy. And then, of course, at the end of the day, you can leave all your stuff to your beneficiaries and they don't have to worry about that IOU money. They don't have to worry about that tax. 1031s are not limited to the state that you are in. You can go across state lines. So I'm here in California. If I want a 1031 out of California into like a place in Texas or something like that, I absolutely can do that. You can 1031 all throughout the United States and keep deferring your tax. You can 1031 over and over and over again, or you can do it once, your choice. Now, when people come to me and they say, "Hey, Nicole, I want to get out of my properties, I want to sell," my first question is why? There's generally usually a reason beyond just the fact that I want to sell. Maybe it's they don't want to deal with the managing of the properties anymore. Okay, well, let's talk about how we can not lose the investment entirely and not have this tax hit, but let's talk about how we can change that investment. Or, hey, I need some of that money because my mother is sick and I need to help with the long-term care. Okay, we need some of that money. Maybe we can get out a little bit of this investment and pull some of that money out without paying this huge tax hit all at once. And to do that, it is called taking boot. You are totally able to 1031 and take some of that money and use it. And so if I wanted to 1031 and take out $150,000, I would be taking out 150,000 of boot and then I would pay tax on that, but the rest of it would be deferred. The rest of my gain would be deferred. Let me give an example. And so in this case, this person was just selling their property and they sold their property and they had about $557,000 of gain with that sale of that property. And that resulted in over $100,000 of federal tax. That's a pretty big pill to swallow. But we suggest let's do a 1031. Take out, you need some of money. Here they want to take out 150 because of basis and because of recapture. When they were taking out the 150, it was really actually only 100 grand that they needed to pay tax on. And so with that $100,000 of tax, or excuse me, with that $100,000 of gain, that resulted in 15,000 and almost $500 of tax. So they got that 150, they continued with the investment and they paid $15,000 of tax. It really helps people kind of go at things in a smaller, quieter, easier chunk about it. 1031s, while they're amazing, while I absolutely love them, you need to do them correctly. You need to get an accommodator and you need to understand how they work. Like with everything, there are rules to them. One of the biggest rules, there's two really big things that people need to understand. One huge thing is you can't touch the money. You cannot sell, take ownership of that money, and then decide to do a 1031. You can't do that. And so you're going to need to get an accommodator because that money is going to sit in escrow. The other really big thing is understanding the timeline, understanding the rules and the deadlines, because these deadlines very rarely are they ever able to be extended. The things of like, oh, well, I had a death in the family. Oh, I went into the hospital. No, it's going to be a failed 1031, and failed 1031s break my heart when I'm looking at them and people are like, I don't have to pay the gain. I don't have to pay the tax. And I'm like, actually, you do because it's failed. And they're like, what? And I'm like, yes, get with an accommodator. Understand that you need to identify the three properties that you want to 1031 into. You're getting out of one property and you're going into another property, and you need to identify three options within 45 days of close of that property that you're getting out of. Generally, I tell people they should have identified before the property even closed. That third property, you're able to identify up to three properties. That third one should be a DST. What is a DST? I always recommend that third one to be a DST, a Delaware Statutory Trust. This is the most passive type of real estate investment. You're basically a very small sliver of an owner of really, really large real estate, $100 million real estate investments. Similar to a REIT, not the same as a REIT, but it's very, very similar. The reason I say that is because as somebody that has invested quite a bit in real estate, I understand how easily a deal can go from amazing to yes, it's closing, yes, we're going to be in escrow, to no, we've fallen out. And so that happens very, very often. And so I always say keep that third one as a backup option, keep it as a DST because you're never going to fall out of the DST. Then, after the 45 days, or in addition to the 45 days, you need to close on the final investment, the property that you're going into, within 180 days. We have 45 days to identify, and then you have really 135 more days to close. And again, I always recommend identify before you close on the property you're leaving. Identify three different options that you want to go into, and then you'll have the full 180 days to close on these properties. The timeline is one of the biggest things that people mess up with, and really understanding that timeline is the key to success, because sometimes that's where people can fall short with that timeline. You need to get with an accommodator. Don't try to DIY it. That also doesn't really find great success. An accommodator is going to help you and walk you through it very, very much. Especially with the escrow portion of it. But a 1031 is a wonderful, wonderful way for people to change and to move with these large investments. You can 1031 from a fleet of cars to like a bunch of boats or to a bunch of horses or something like that. It doesn't just have to be, like rentals that you can do. You can also go commercial to residential or residential to commercial. There's all different types of ways that you can go. Yes, there are rules. There are a lot of rules about this property to that property. An accommodator is going to be the best person to help, but people are very surprised what they're able to 1031 into. You just need to ask. Talk to somebody and ask if you can do it, and you'll be highly shocked about it. Okay, I want to open it up to some questions. I have chatted and given some three examples about what's going on. In the meantime, if you guys would like to set up a discovery call, go ahead, scan the QR code. Here's my email, Nicole.Green at Robert Health Taxes. We are putting up a poll. If you would like to hear some more information, please fill it out. Please make sure you include your email address and your phone number. It just helps with my team reaching out to you guys. And then if we have more questions or any questions, I would love to.
Yeah, thank you, Nicole. We've got a couple questions here, so let's take a look. Can you offset my wife's W-2 income?
If you are a real estate professional and the real estate, I think that's what the question is in regards to. If you are a real estate professional and the real estate is in your name, you can offset anybody's, yes, your wife's W-2 income.
Okay, wonderful. Thank you. And just a reminder to everyone on the webinar, please put your questions in the Q&A link at the bottom, so then we can make sure we get to everybody. But I did see over here, let's see here, that someone is asking, thanks for the presentation. Could you expand on the use of DST?
So, Delaware Statutory Trust is similar to a REIT in the sense that you are a very small owner. I mean, it really depends on how much money you put into it, but generally, people are a very small owner in like these hundreds of $1 million real estate investments. Sometimes it's, like these thousand unit buildings and real apartment buildings, or it could be a mall, it could be whatever it is, and then you're just a small owner in that, and so you're receiving the rents just like you normally would. You get a portion of the mortgage. You just really don't have much of a say, well, not really any say, because you are just such a tiny passive owner in it. And so DSTs are really great options for people that are just tired of managing rentals, but they still want that rental stuff. I believe you're generally paid out quarterly. Generally, I mean, you gotta. There's a bazillion of them out there. You gotta find the right one that works for you. But it's that.
Great, thank you. On to the next. Is it gross income or net income from regular work? And I don't know the
Oh,
reference.
I think this is about again the real estate professional.
Yes.
Wait, is it about the real estate
Well,
professional?
that same individual went on to ask some follow-ups. Adjusted gross income should be under 250,000. I don't know if that helps
Oh,
you.
I think they were asking about the passive losses going against, I
Okay.
hope so. And if not, please pop in and clarify. If you're talking about the passive losses going against other types of income, passive in passive losses can go against other types of income if your modified adjusted gross income, your Maggie, is less than 150,000. And so that's going to be your Maggie is net. It's like after all your expenses and stuff like that. It's basically your net income is under 150. It starts to phase out at 100,000. If you're below 100,000, you're able to take up to $25,000 of passive losses.
Okay.
um I think that's what it is they were talking about.
Okay. And then I do have some clarification here. The real estate professional status is what they were referring to.
So, real
So,
estate professional status has the three rules to meet, right? You need to have the 750 hours, which is the easiest. Don't worry, everybody can meet that. That one, everybody just go check to that one because everybody absolutely can meet that. Then the majority of your earned income needs to come from real estate. If you have no other earned income and your earned income is like, $2, as long as that $2 is, and you have no other types of income, is more than that, then and it's in the real estate, then totally fine. There's no minimum amount of income that you need to have. And then of course the majority of your time.
okay, perfect. Let's keep going here. Is bonus depreciation available for 2025 or this year purchase will qualify too?
2020, it's about 100% bonus depreciation for 2025 up to the next 4 years. Now, when bonus depreciation was phasing out, people were freaking out. And I remind people that yes, 100% sometimes does go away. It phases out, but there's still always bonus depreciation. It just might not be at 100%. But for 2025, if you purchased or put, it's not even purchase, it's put in service. So you could have purchased it in 2022, but you didn't start to use it for business purposes till 2025. And so if you put it in service in 2025, it's available for 100% depreciation. If you do it in 2026, 2027, 2028, that's you can also do 100% bonus.
Perfect. Thank you. Let's move on to Alexander. Here we go. Thank you. What about state tax on 1031 from out of state exchange?
Deferred. All 50 states conform to 1031. That's one of the really great things because you bring up a really great point that not all states conform to what the federal government does on the tax side. And 1031, the states conform. Cost segs for bonus depreciation, most states also conform to cost segs because not all states conform to bonus depreciation. But through a cost seg, they will conform. But for 1031s as well, they also.
Wonderful. Wonderful. Thank you. Keep them coming, guys. What can one do if the property that one wants to offload has not appreciated much or at all? No need for a 1031, but another way to enhance the situation?
Yeah, so that brings up the point that I was trying to make earlier is you need to see the benefit. Like if I the amount of boot that I want to take out from the property, like the amount of income that I want to take out for the property is more than half of what I'm trying to defer into it, then it doesn't make sense to 1031. No, it really doesn't. Like because there is an expense to it. And so if you're going to be at a loss, then why? Or if the gain that you're going to have and the tax that you're going to have is not that much, sometimes you just say, no, take it. And so, again, I tell people talk to their advisor so we can understand what the real numbers are. Hypothesizing, not nobody really likes to do that so much. Like you need to give me a glass of wine if you want me to hypothesize on stuff. But like if you're really got some real numbers and we can run some stuff about things that you're really trying to do, then we can go ahead and see. Because like if you've got, 15, $20,000 of tax, why are we doing a 1031? Pay the tax. Like, and then you're completely free and we're restrictionless.
All right. Awesome. Jessica has a question. If you sell your 1031 exchange at a loss, what happens to your deferred gains?
Okay, so let me clarify this question. I completely understand the question. The question is we're going to set the scenario and hopefully I can do it really clear. I just want everybody to be on the same page. So you bought house A, then you sold house A at a house A appreciated. We sold house A at a gain. Now I 1031 from A to B. I deferred A's gain and now I want to sell B. I'm going to sell B at a loss. I still have A's gain. And because I'm now breaking the agreement, I still have to pay tax on A's gain.
Okay, wonderful. I see Jessica expand a little bit, but I think you answered her question. Perfect. So let's go. Terry, DST income is considered passive income. Can that be offset against your regular rental income?
If it is passive, then yeah,
Okay.
because passive losses can go against passive gains. And then you can also combine all of your real estate so that not like actually combine it on your tax returns. You're still going to have multiple Schedule E's, but you can elect to come to think of all of the real estate as a single real estate investment or single real estate business. I think that is what they actually determine it as. And that can and also include your DSTs so that you are so it can help for you to be a real estate professional. So
Perfect.
you can make that election. But if it's all passive, then you can, and sometimes we have that where we'll combine some properties because maybe they have four properties, two of the properties have management companies and two of the properties don't. And so we can combine the ones that don't have it so we can consider that a full investment. And then the ones that do, we leave those alone. But yeah,
Awesome. Thank you.
sorry, it's a long answer for yes.
I think that made sense to me. Um, can I do a 1031 exchange out of a DST?
Yeah. To be fair, because like I said earlier, everything has their good and a bad. DSTs do have some of their drawbacks as well, and you can't sit. Generally, people don't are not able to sit in DSTs for 20 or 30 years. You're gonna they're gonna require some movement, and a lot of times, what people end up doing is 1031ing.
Okay, wonderful. Speaking of 1031, from Rebecca, in a 1031 exchange, is trade from old improved dwelling to vacant land okay? And alternatively, is a trade from vacant land to improved okay?
I think you're going to run into issues about the vacant land portion because vacant land is not considered a business.
Hmm.
And so if you're going to do like new construction or you're going to build, if things are pre-permitted and stuff like that, you can possibly get with that. If you're thinking of land in terms of like agricultural or like you actually develop land and sell, then that might be then it would be a little bit different, but it can't just be like I own a lot and I'm trying to just like plain land because that's not business.
Right. Okay. Perfect. What is earned income from Frank? What is earned income, dividends, stock capital gains, annuity proceeds?
It's a job.
Job.
Like it's yeah, it's a job. Like dividend, stock, all of that. Like you're not doing it. If you are the one that is actually managing it, then you need to tell the government, and we call that a mark-to-mark election, where you're saying like, no, I do this as a professional because things like dividends and stock, generally for the general public, take a shot every time I say generally, um, is going to be passive. You know, like if people don't generally I don't want to say that word anymore. People on average are not the ones that are managing it entirely. And if you are, you have to take a specific election and there's whole ins and outs about that as well. So
Okay.
it's a job.
Wonderful. Still talking about 1031 exchange from Annie. I have someone else popped in there. I have done 1031 exchange. The 27.5 year depreciation is completely used up. What options do I have to get some additional tax savings on that property?
I would say that you should sign up for a consultation because I need more information. I need to
Okay.
see what else is happening in the property, what else is going on, maybe outside of the property. We might need to branch out a little bit whole. But I don't have enough information to answer
Yeah,
this.
so Annie, give her a call, send her an email. All right, here we go. The next one is, do you have to be a real estate professional to use the accelerated or bonus depreciation?
No, but you will need to meet the passive loss limitations. And sometimes you can be strategic to not claim real estate professional, but you want to go ahead and pull that depreciation forward for other particular reasons. And so you need to make sure that there's enough of it and why are we trying to do it. But if you're not a real estate professional, and you're at a W-2 job and your W-2 job is more than $150,000, should you be doing a cost seg? I would say maybe not, but I would want to know more about your situation.
Okay. Thank you. That was from Mark. I managed to catch yours over there on the chat. Couple more here. Can you please explain the income slab to be able to turn passive to active as real estate professionals? And the modified gross adjusted income should be under 150.
So no, two things. So if I'm not a real estate professional, if I'm just me, and you can't qualify to be a real estate professional. You're not a real estate professional. Don't want to be, whatever. And your income is under 150,000, then you're able to use a little bit of passive losses to go against other types of income. It maxes out at 25,000 if you're under $100,000. If between 100 and 150 you can use a portion of that 25,000, and at $150,000 of total of your Maggie, your modified your income, just call it income, your income is at 150, you can use no more passive losses. Your zero passive losses to go against other income. If you have other passive gains, you can, no matter what your income is, you can use passive losses to go against other types of passive gains. You don't lose these passive losses. These passive losses you'll carry until you're able to use them. Now, on the next step, a completely different situation, if you want to be a real estate professional, or if you can qualify for a real estate professional, the majority of your earned income needs to come from real estate that you own or partially own. And then the majority of your working time needs to be in real estate. And then you need to meet the 750-hour rule.
It's only February 5th, and I feel like I've already worked 750 hours.
Probably.
Can you, next question, last question we've got going on here, and a couple thank yous to you for the presentation. So appreciate
Absolutely.
that, Nicole, from quite a few people on here, that you've answered their questions. Last one so far is from Frank, and is asked, can you still be a real estate professional if it is all in a single member LLC?
Mhm.
There you go, Frank. Uh-huh.
As long as you are the member. Like it can be in a trust, it can be in a single member LLC, you can be real estate professional if it's a partnership. Like, yeah.
All right. Couple more questions if you still have a few more minutes,
I
Nicole.
do.
Perfect. From Joel. If I only have real estate rental income in a particular year and I qualify as a real estate professional, is it just easier to indicate I'm a passive investor as there's no benefit from declaring as an active investor? So no W-2 income to reduce.
I would say let's branch out outside of this particular year because you have options. And I think that's what the definition of being wealthy is to have options. It's the ability, like I can choose if I want to. Because yes, maybe this year doesn't seem like to have any tax benefit, but what's going to happen next year? And so if I have losses that I can carry forward to next year, and active losses also carry forward. And so if you go ahead and say you're a real estate professional, you have active losses that you don't use this year. And then next year we have earned income. We can use those losses from last year for next year, like, or from this year, next year. So I would say you should expand your thought process beyond this 1 year.
Okay, wonderful. One last question here, and I do want to remind everybody that a recording of this session and all of the slides will be emailed to you tomorrow, by the end of the day tomorrow. So I see a couple of questions coming up about the slides, so I want to remind everybody of that. Last question, Nicole, unless anybody's got any more. If my tax guy did my taxes incorrectly and I need to amend to claim the deductions, does it attract an audit?
Anytime you amend your tax return, it draws more attention. That is a general effect. Does it mean you are going to be audited? No. Does it mean should you not audit for like real deductions? No. I would say, what are the deductions and what are we deducting on? It would need more information. I'm going to give you an example here. Let's imagine person A has a small business that they just started and they're doing like Etsy or whatever. And they forgot some of their deductions. They had $5,000 of revenue. They have a normal W-2, but they have $5,000 of revenue and they took like a $2,000 loss. So $5,000 revenue, $7,000 of expenses, took a $2,000 loss. And they realized, oh, I forgot about 3,000 more of expenses. And so they wanted to take, instead of this $2,000 loss, a $5,000 loss. Would I amend for that? No. I would not amend for that. But if you have a rental and only positive income was put in and you did not depreciate your rental, you depreciation is not an option. You have to depreciate your rental. And when you go to sell the rental, even if you hadn't been depreciating it, you still have to recapture the depreciation that you never took. Um, so you're going to pay twice on that. So would I amend because I didn't depreciate my rental that I was supposed to depreciate? Absolutely. I would amend for that deduction. So my question would be, what's the situation type of thing?
Right. Is it worth the risk?
Yeah,
Okay.
is it worth, and like, are we gonna win the situation? Like in both cases, they're right, they're legit. In both cases of the extra, I don't remember what I said, $2,000 or $3,000, and here the appreciation, both of them are genuine. But Sometimes you gotta just accept.
We're going to squeeze one more last question in here. Can passive losses from last year be used as active if you qualify as a real estate professional this year?
No.
Nope, there you go. Simple and easy question. We're gonna squeeze one more in. One more in. I promise this is the very last
You're
question.
good, don't worry.
Rental property's been in probate for 5 years.
Oh,
Does this information apply to the deceased owner while part of the estate when the one who inherits them starts over with depreciation at the transfer time?
okay, so it's been in probate for 5 years. So, okay, there's a little bit of a thing here. And so everybody that inherits something gets stepped up in basis at the time of inheritance and so at the time of death. So if the person that passed away bought the property for $100,000 and when they passed away the fair market value for the property was $1 million, the beneficiaries will get the basis of that property at $1 million, and that starts at the time of death. So if it's in a trust, they should have already applied that step up in basis, but it's through probate, so I don't know what it was sitting in. But that whatever it's been sitting in during that 5 years, because it should be sitting somewhere, but whatever it was sitting in during that 5 years, that's where that step up in basis would start.
Okay,
I hope
wonderful.
I was clear enough on that. And if you need more, we can get in more detail if you like want to just like send me an email, we could schedule a call.
Okay. And I see, and I keep getting these last ones popping up.
You're good,
So,
don't worry.
okay. Can I do a 100% bonus depreciation of a property purchased on January 10th, or would it still be applied the 40% bonus depreciation?
January 10th, 2025, January 10th, 2026, you're able to use 100% depreciation.
All right,
Bonus
William, that
depreciation.
answered your
I mean,
question.
if it's a property, we're going to need to do a cost seg so that because bonus depreciation does not qualify for timelines of 27 and a half years. So you'll need to do a cost seg, but the time isn't the issue.
Ladies and gentlemen,
And you can, oh wait, so sorry.
oh,
You
go
can
ahead.
do, if it was January 10th in 2025, you can do the cost seg today. And it's fine. They can still figure out all of that stuff for January.
Okay. Thank you all for your time. Nicole, wonderful as always. We're getting lots of comments over here saying this was the best tax class I've had in real estate taxes. You are awesome.
Oh, that's so kind. Thank you so
Yes.
much. I really enjoy doing these things. And you guys put on and have really good people to come in. It's a pleasure. Thank you so
And
much.
my screen is being filled with hearts over here. So I'm loving it. I'm loving it. I'm loving it. So, ladies and gentlemen, thank you for your time. If you're on the other side of the country, please stay warm. It's a little cold out there, and if you're over here on the West Coast, enjoy the sunshine. Nicole, you and I are just around the corner. So, thank you to everybody, and don't forget to check out the newsletter and magazine for a list of all upcoming webinars. And if this was YouTube, I would say don't forget to click and subscribe. But I appreciate all the hearts and the thanks. We will see you all another time. Have a good one, everyone.
Bye.